Welcome to Golden Nuggets, the Situation Zoom. Yes, we had a slight name change from the Situation Room, and that was a deliberate one because unlike my usual studio setup, this show isn't about production polish. This format is designed to be fast, frequent, and responsive. We want to capture the market as it moves, not after it's been packaged. So this is less about how it looks and sounds and much more about what's actually being said. And now today I am joined in the Situation Zoom by three voices in the industry who have built a reputation for being, let's say, data obsessed or slightly more data obsessed than I am. We have Rakesh Mavath, who is the co-founder and CEO of Takeem. And I've got a fun fact for everyone. Don't hate me for saying this, but in his previous life, I learned this last year. In his previous life, he was a music producer and he actually produced for Beyonce and Christina Aguilera, and he produced a song, Who Run the World Girls. Am I right?
That was one of the co-producers.
One of the co-producers. Did you know that, Lynnette?
No, I'm singing it in my head right now.
There you go. And if only the girls really did run the world, we probably wouldn't be in this position, would we? We'd have probably hashed it out a long time ago or just politely, I don't know, just held a peaceful grudge. But anyway, moving on. We also have Lynnette Sacchetto, who is the founder and CEO of Real Trust Digital Conveyancing and Escrow, or Digital Escrow and Conveyancing. She's always been known as the data queen of Dubai. I don't think anyone has dethroned her from that title. Okay, so it can stick. And we've also got Stewart Kirkham, who is a strategic advisor with a master's in real estate. And he's got 27 years experience. And sorry, I should have also mentioned Lynnette is a Harvard graduate. So I've got a Harvard graduate and an master's in real estate and BA in global economics. And I recently was acquainted with Stewart because he is a top voice on LinkedIn. Major kudos for that. And he's been quite vocal and consistent in the last couple of months, certainly kind of as the conflict has unfolded. And I don't know if you were doing the READ analysis, so READ, READ, real estate analysis Dubai. Were you doing that before or?
It's been going on now for about almost a full year and a half.
Okay, all right.
And after a while, it sort of takes on a life of its own and we just keep on going.
You keep going, you keep it going. You certainly got my attention. I'll put everyone's links in the description. Be sure to follow all of them and give some engagement to Stewart's weekly read that comes out. Now, I'm going to be the first.
It's a top read. It's one of my
It's a top read, yeah.
reads every week.
So is
Right.
yours, Steve.
Sorry.
So is yours. So is yours.
Yeah.
I'm a bit more ADHD, just like
Rant.
diarrhea and rant. The angry old man syndrome.
No. It's very good.
I'm going to be the first to admit numbers are not my strength, never have been. It's not what I use to make decisions. Lynnette, you know me very well. I'm more of a vibes girl. And whatever the algorithm is thrown my way, I tend to lean more towards sentiment and feels, which is probably not the right behavior. So today, I'm leaning on all of you to help paint the bigger picture through the data that you're watching and perhaps give us some inside info on what we should be looking at and the signals that actually matter. Because I heard something the other day and it was really important. It said signal over noise or more signal. Yeah. Less noise, more signal. And I was just like, do you know what? That should be the tagline of this show. So to set the tone for this discussion, if each of you could share the top 3 data points or indicators that you are watching most closely right now, particularly in light of the current environment, and then we can build the conversation from there. What are those 3 data points you are tracking and why? Let's start with Lynnette.
Sure. So ever since the conflict started, I started looking at the data more daily. Before I was not so much, just because my scope of work is not so much involved in data anymore. And the first data point I'm looking at is the secondary market, because that's really, truly, in my opinion, what is happening in the market today, the traction that we're seeing, what kind of properties are being sold. So that's number one. The second data point that I'm looking at is the type of leads that we're getting in March and April versus January, February into our company. And that's very important because the leads have shifted, the type has shifted, the topography has shifted, location has shifted, everything has really shifted significantly from the first 2 months to March and April. And then the third is I'm looking at developer launches. I'm looking to see what the developers are doing now in the last 2 months.
Particularly the payment plans or just volume of launches?
No, just new launches, the type of launches. Obviously, we've been seeing quite a few in Abu Dhabi and they've been very successful. Why have they been successful? We have the answer for that. So it's just very interesting to see the dynamic of the market. And these are the top 3 data points that I look at currently.
Nice. Stewart.
Sure. So I watch a lot of the things that Rakesh publishes, but I'll let him cover the ones that he likes to talk about. But there is some rich data that we like to collaborate on, and we actually frequently talk about it during the course of the week. Lately, I've been focusing on population growth, and population forecasts. That's something that is important, not just in terms of the headline number, but then how we segment that population and what it means over the course of the short, medium, and long term. On a more macro level, the latest figures that we receive from World Bank and IMF in terms of overall GDP. The reason why I focus on that is because there's a direct relationship to what we might be seeing in the overall economic production base, which has a relationship with jobs and employment growth. And so the jobs figures are the other ones that we're really kind of focusing on the macro level.
Was that 2 or 3?
I think it was sort of 2.5.
Okay, we'll take it.
I'll give you the other one that I'm looking at because it's a little bit more focused on the business that I'm working on at the moment. And that's a lot of retail sales figures from a lot of the major shops, both the large inline anchor stores and fashion retailers. And those really gives a sense of what is happening in terms of people's spending power and what they're doing with their pocketbook. Not all of that is necessarily public, but those are things that I'm focusing on.
I have to interject there because I come back to London quite often. And one of the key measures for me is Oxford Street. I'm sure you all know Oxford Street.
Yes.
It's very close to where I live. So I'll definitely have driven past it at least 2 or 3 times on every trip. And that to me is my indicator of this shop's closed down, that's empty, this one's just new opened up, that didn't survive. So that is a very good indicator. And I never thought about that actually from a Dubai perspective. Okay. And Rakesh.
Before I get into the 3 data points, I think it's a little bit interesting, the 3 people you've got on the chat today. And there is one common thread between the 3 of us, as that we've all built businesses revolving around trust, and data is an important element of that trust. I mean, Lynnette's company literally has it in the name. We trust in everything we do. We're building that trust infrastructure, and Stewart with his data analysis is all about trust as well. So the 3 metrics that we're looking at mostly, of course, is the volume of long-term rentals, because you may look at sales figures that are being registered right now, but that's data from 2 months ago. What's happening on the ground now is people making those immediate decisions, and that is whether they decide to long-term rent or not. The second one and the third ones are actually related. The amount of job loss that's happening, and therefore that leads to the amount of defaults that is happening, is something that we consciously look at every day, update our model every day based on those 3 criteria.
Where are you getting this information from? I mean, could you just, because I know, Lynnette, you're always talking about reading, but information like job losses, how would you know? Where do you get that data from?
Because of our product, because of what we do in protecting landlords against their tenants defaulting for job loss. So we're on the front line of that. We see it well before it even gets recorded as a registered default, plus our proprietary data set of both private and public information that we have access to be able to evaluate risk on our product. So it's those elements there that give us that forward knowledge of what's happening today, which most people won't even realize for 2 months.
Okay. And Stewart, population growth. I know, there've been headlines, 100,000 Brits have left.
Yeah.
How did they get that number?
Closer to 30,000, but it's not, look, there's you have to rely on some of the institutions to be able to give you a clear picture. And Citibank, for better or for worse, came out and said that our population growth, which was previously expected to be around 4 to 5% for the next couple of years, is now going to be around 1%. And other people wanted to challenge that. Okay, maybe that's splitting hairs. But when an institution comes out with it, they have the economic muscle and brains to validate and vet that data. That's interesting. Just like when you see the World Bank revise a figure or IMF revise a figure. It goes beyond just somebody publishing something and saying, I believe this because of the way the wind is blowing, right? It needs to be something that can be vetted, cross-referenced, and challenged. And the reality of it is when you focus on forecasts, is that forecasts are inherently going to have a big margin of error. Now, if their forecast is 1% and it ends up being 1.5, does it mean that their forecast was wrong? Not necessarily. It just is a correction based on the current risk assessment that needs to be taken into account of how we look to plan over the course of the medium to long term. The other thing too is that there's proxy points and there's really interesting data that we can dive into. And one of the ones that will be very interesting for us in a couple of months is schools and renewals of enrollments. And so that has been a figure that I've looked at over the course of my career being in this part of the world, because you don't necessarily always get a clear picture, but that's been an amazing proxy element for the last several years, and will definitely be an interesting one coming in August, September.
What would you say the data that you currently have access to is telling you about the health of the market right now?
Look, I think that the market is showing a certain amount of resilience, but it's also demonstrating tension. And the tension is where it becomes interesting from a risk management or a portfolio management or an asset management dynamic. I don't think that it's easy to say that it's a binary one thing or the other. There were pressures that we were facing before the conflict started. And the conflict has exposed some of those in different ways that we expected and other ways that we didn't expect. The market in general is healthy, but it is going through a corrective period at the moment. The question that I think everybody is wanting to understand is this going to be a quick recovery? Is it going to be a prolonged recovery? Is it going to be dramatic recovery? I don't think anybody has that crystal ball, but I think it's more acknowledging that it is a recovery. There's opportunities in recovery, and then being able to plan ahead for those new realities.
Yeah. And Lynnette, you and I have spoken in the past about, we both had concerns irrespective of the conflict, even well before the conflict. You were looking at the off-plan handover numbers and raising a few concerns, like how are we going to keep up with the supply? So it was there already. How has that changed now?
Yeah, so I would say the last year, H2 of 2024 and probably 2025, data people were kind of looking at the market, at the data, thinking something's got to give. This cannot sustain, especially with the off plan. And I just looked today, there's 508,000 units under construction today. That's just insane. Like if you look at that number compared to what's existing in the freehold market, it's a little over 600,000 that's already existing. So something had to give. Unfortunately, this conflict is what has caused a shake or a stir in the market. Now, obviously, the dynamics change. So it's not like it was an economic downturn due to inflation or due to a recession. It was something that happened, boom, very quickly overnight. And obviously the markets they still haven't recovered. They still don't know how to recover. There's still that element of uncertainty. And until there is certainty, I truly believe there won't be a full recovery. But going back to the original question that you had, Sylvia, yes, obviously something needed to give within the market. Rakesh was all over the rental market and what was happening, especially with the declines and the defaults. And obviously it's going to be exponential. And I'm sure Rakesh will talk about that and how the rental market has completely made a 180. But also within the sales market, we're seeing the same thing. Obviously, like I said, it was a shock that happened, so you can't really look and like Stewart said, we don't have a crystal ball, and because of the situation, you can't really project on what's going to happen. It's very difficult until there's certainty. Then when there's certainty, there will be a time frame after that, maybe a quarter, 2 quarters, where we'll start to see kind of a rebound, but nothing like COVID. It will not be a V-shaped recovery. It will be very U-shaped and will take a while because it's going to take time for confidence as well to come back into the market. I mean, I think we've all been here during this conflict, and it's been incredible how the government has reacted, how proactive they've been, how we've been taken care of, how safe. I mean, if this happened in the US, I cannot imagine, really. The defense system is not there. We were safe here. So obviously, that recovery and gaining the confidence back, I think, will be a lot easier here in Dubai compared to if it happened, for example, in UK or US. But again, going back to that data question, yes, we were raising our eyebrows. Now that problem is exponential with off plan, and we know the situation that the developers are in. We know that they're going to continue to construct. We don't know at what point that will change. And there's, I believe, 180,000 units to be completed this year.
Anyone who's read our stuff knows what we were predicting, and we called it quite a bit before anyone else. And this was one of the risks that we said was available to the market. What we're seeing now is probably the greatest convergence of risk since 2020.
Oh.
And the data has shown that. The data is telling us exactly what mature markets do. Now, I'm a very strict believer in using economic definitions of what is a correction, what's a crash, what's a recession. A correction is anything above 10% up to 20%. Above 20%, then it's a crash. A recession is 2 quarters of negative growth. We already saw that the volume in the rental markets had 2 quarters of negative growth in Q4 2025 and Q1 2026. That was already on the cards. The current situation has basically accelerated and magnified what was already happening. March came in at minus 29%, and that's not a headline to panic over, right? It's actually a headline to respect in some ways, because Dubai has gone through extraordinary growth. It's gone through 4 years of hypergrowth, and this is just the natural occurrence of what happens after that. The laws of gravity even apply in Dubai, even though we've built the Burj Khalifa, and maybe people think that we're bypassing the laws of gravity. But what the data is really telling us is that Dubai is growing up, right? We're transitioning from that landlord-driven market where they were in control to something much more closer to an equilibrium or getting there. And it's that transition where something like trust infrastructure matters most. It's exactly what Lynnette was talking about confidence. This market can handle softer prices, right? What it can't handle is a breakdown in confidence, because that's what Dubai has been built on. It's confidence because we've seen His Highness's plans and we've seen how well they've been executed. We know that it was a safe haven for so long, but we need that confidence, especially in the rental market, between landlords and tenants. And that's the part we need to get right. And it's not one side or the other, it's both sides. So I'm going to finish by saying, I don't think Dubai needs cheerleading right now. We've got that in the bag. We've got the results. We've got the history. It needs honest data and infrastructure that works for every person in every stakeholder in the economy.
So, of course, like, rentals is an important part of the allure, shall we say, because if you're an investor or a foreign investor, you're looking at your returns. You're looking at the yields you're being promised, the return on your investment. If there's a hit taken on rental values, then the numbers just don't make sense until the property values also come down. Everyone expects at least 6-7% returns. Would you say that's fair?
It's definitely fair. We've seen yields up to 9%, and at 6-7%, it's still well above pretty much every other country in the world. So if there is a decrease in that yield, then it's still sustainable for the foreign investor. What's not sustainable for the foreign investor, having no control over what happens when a default happens or something like that. It's that confidence that we have to give to the market to say, listen, Dubai is a really safe place to invest because the infrastructure is built there for this. Your rentals are secured, your rent's guaranteed, your yield would still be well above international, but it can't take a hit of losing 4 months rent, plus then going through the legal costs and everything else that may happen.
Stewart, that's where your numbers come in, because you're looking at population growth, affordability.
Well, the concern for any mature real estate market is ensuring that the market being served has the ability to afford that market. At a certain point, and at some of the escalations that we were seeing, this is conversations that Rakesh and I have had, is that there is a concern over affordability. There is a concern over wages being able to afford the end stock, whether it's the 200,000 units coming online or the 500,000 units coming online, and who is going to fill them and why are they going to be there, right? So look, if we are not able to afford the product that is being built for us, then we have a problem that will need to be addressed. What was happening at the beginning of this year and has probably been accelerated as a consequence of the crisis is affordability is becoming much more of a key element in people's vocabulary in the way that we are looking to structure deals, purchase things. We can only have so much 5-star for so long, right? It needs to be approachable to what is our end user base that we currently have here. When we have issues of wages declining, issues of job loss, then that adds to this affordability element that we need to make sure that we can maintain.
I mean, Dubai is definitely a little bit, we're all a bit excessive when we get there. We start spoiling ourselves, living maybe perhaps slightly more lavish lifestyles than we would back home. And been living in Dubai for 9 years. And the one thing that I never do, or I always try to avoid doing, is converting my annual rent amount into pounds, because maybe I did it once on the calculator and I was like, who the hell do I think I am? I would never spend this much in London on rent. That would get me like a 3-bedroom mews house in Holland Park. Like, who am I? Why am I spending this much on rent? But it's because I'm earning in dirhams that I allow it to be a certain percentage of my income. But in the UK, obviously, a large chunk of your income goes towards tax. That is the difference, surely. There's income, and then there's the fact that you're not being taxed. So where does that play a part in affordability and rental behaviors?
I mean, look, it's okay if you are able to manage your overall monthly spending and have a higher proportion for rent. What we do know is that Dubai does have some of the highest proportion of monthly revenue attributed to rent on a global basis. And when we see certain other pressures, whether that's growth or job growth or employment growth coming into play, then you kind of wonder, is that really truly sustainable? And this has been sort of the issue of bid asks between landlords and tenants over the course of the last couple months, is that kind of people are realizing I kind of need to check myself here. I don't want to have excessive sustained vacancy because I was greedy at trying to capture rents that are no longer achievable in this market. And that's really what I think we will start to see. It's not a negative behavior. It's a normal feedback loop in any kind of mature market. And that sort of is the new reality that I think that we're looking at.
So does anyone have any visibility on the renewals data, the latest leasing data? Of course you do. Of course you do, Rakesh.
There's been a massive uptick in non-renewals and early terminations for either people leaving or people knowing there's better deals in the market. From speaking with a lot of property managers this week and agencies this week, we've done the whole roadshow in the last week. We're seeing a lot of tenants leave that decision of renewal to the very, very last day. And by law, that's their legal right. But it means that they're in the negotiating power now. They're negotiating with their landlords about how much of a decrease they can get. And if not, then they're more than happy to move across the street where they know that price is available. Some landlords are resisting the change. They're still living in 2024, 2025. While others are actively knowing that it's better to have a tenant than to have a vacant unit there. So what we've seen is in 2024, early 2025, we really saw an affordability ceiling get hit. And that's why we saw the drop in the numbers of rentals in a volume sense. More than there was a 5% growth of population last year, yet there was no increase in long-term rentals. So you have to ask the question, where were those people living? Is it
Sharing?
moving to other Emirates because they couldn't afford Dubai anymore, or just leaving altogether? So yes, we were seeing a drop in demand. And I always have this saying that if prices drop because of supply, that's a good thing. If prices drop because of demand, that's a bad thing. When prices drop because you have increased supply and lower demand, then that's the time to listen to your mum when she told you to wear a clean pair of underwear, because that's the worst case scenario, right? And unfortunately, that's the kind of situation we're in right now, because we know the supply is coming to the market. We know a lot of short-term rentals have switched their premise from short-term renting to long-term renting. So while we are seeing less demand, because with the long-term rental market, it's very circular. We have people leave, but we have a whole bunch of new people come in as well. Right now, one of those doors is closed. So we don't have those new people coming in, and yet we have more supply coming to the market at the same time. This is totally absorbable on a very common basis. But what's going to kill that absorption is any friction that we have between landlords and tenants. So we've got to make sure that the experience is as smooth, as trustworthy, and as profitable for every person in the as a stakeholder, that they can get some resemblance of a win out of it as well.
So, I mean, in terms of trust, I think coming from the UK, there is a real emphasis on credit checking, landlord referencing, employment referencing, and maybe checking tenants' 6 months bank statements before you even accept an offer. Whereas in the UAE, Emirates ID is enough, and a check, basically. So we have that trust already. The fact that they have their Emirates ID, it means they're employed, they're unlikely to bounce a check. So there's a lot of trust inbuilt into the system.
Is it trust or is it hope?
Hope?
Right.
Or is it expectation?
It's an expectation isn't trust, right? It's hope. Because unless you're looking at those figures, that's trust, because you're trusting a credit bureau, you're trusting a rental guarantee, you're trusting a reference from a different landlord. Just using an Emirates ID, and you can't look at the employer and say what that employer is like. What's the financial stability of the employer, right? What we've seen recently is, especially with low to mid-tier white-collar jobs and the whole streamlining, AI taking jobs, this is even before the current situation, then these were stable tenants who had paid rent for a very long time. Their landlords considered them incredibly dependable, but all of a sudden they didn't have a job anymore. So we need to build that infrastructure where it is real trust and not just hope, and hope on a piece of stationery, which is the check system.
So in my first episode of The Situation Room with 3 of the top brokerage CEOs, Rick Wayne, Louis Alsop, and Abdullah Al-Ajaji, I asked them what government initiatives or new policies they'd like to see come into play. If it were down to us, is that whole monthly payments rather than paying your rent in advance 3 months or half yearly? Is that something that you think would improve trust, or what checks and balances would need to be done?
This is something we live and breathe every day. The reason why since 2022 have no longer been a criminal offense. The illusion of check as a security is no longer there. But landlords won't make that switch unless they have some form of confidence and security. And this is the reason why we built Akeem, is to give that confidence and security to a landlord to say, listen, if your tenant doesn't pay, we're backing it, right? You know you will get your money. We'll pay 4 to 6 months of that tenant's rent in case something unfortunate happens to your tenant. So yes, the more that builds in, it is going to switch to a monthly payment as the trust and confidence from tenant and landlord and regulator and agents all combine.
So would that actually damage your model if monthly rent payments came in?
No, not at all. Not at all. The risk stays the same, right, for us. So for us, it doesn't affect us at all.
The thing that's interesting about the monthly payments as opposed to the quarterly payments, and I think Rakesh can probably articulate it along with Lynnette, is it actually is not beneficial to both parties. It's a perception that it's beneficial to a landlord that you're getting a check, but that check might be worthless. And then you're stuck with a default, and then you're stuck with a legal case. Whereas if it was a month-to-month system and it was a little bit easier to remedy any of those issues, then you might not have something stuck in a limbo for a longer period of time. So it's rather archaic if you look at global top tier cities, it's a very small universe that still have this quarterly check thing or biannual check thing. You know, it's going to take time, but it's a misperceived allocation of hope on a tenant as opposed to risk management.
And Stuart, can you give us an idea of, we touched on affordability, but I'd be keen to know globally what the typical rent to income ratio should be. So I think in the UK it was like 30% of your 30 or so percent. What should it be in the UAE, and how does that compare to major cities?
It should be 30% or lower. I mean, it's changed over the course of the last 15 years. When I would underwrite properties, I used to do it at 20%. That worked really well in the US. It doesn't work really well here. 30 to 35 is where we've been at. Rakesh probably has some better figures there, but the issue that you get is as people's paychecks get diminished, either because they didn't get salary increments, they lost a job, or they're actually facing a salary decrease, which may or may not be even legal under UAE labor law. You know, they'll deal with what they have to take care of as their priorities: food, power, and electricity, internet, little things for the kids. If they have a check that is not going to come clean for a couple of months, then actually they get a false sense of security that the situation isn't as bad until it is. And so it gets moved down the line in terms of priority. And that's another reason why, if we did it on a month to month basis, it might actually create a more efficient marketplace.
And I suppose the same could be said of mortgages. But do we know what's the balance between mortgaged ownership versus properties that are paid for outright? Like, are we likely to see many defaults coming up in mortgage payments, or is this more of a rental specific problem linked to affordability?
So the last number I heard from DLD, I was in a meeting with them, and I think they published it recently, actually, in January, is that 70% of the residents here in Dubai rent. Rakesh probably better, but that's the number that they give. The amount of mortgages have increased significantly over the last few years. Dubai has always been a cash payment city. The UAE, the region, it's always been cash to purchase properties. But with more expats, Western expats coming in and then deciding to buy, like I said, over the last few years, mortgages have increased significantly. I believe the last time I looked at the mortgage stat, which was at the Q4 of 2025, 60% of the purchases were mortgaged here in Dubai. But for the rental, Rakesh, am I right about the 70%?
Yeah, so it's just over 70%. One of the highest in the world. The IMF and World Bank say 30% is the affordability ratio. Given the average price of rent at the end of 2025 and the average salary, now we say average on both. We're going to use average on both of them, or mean on both of them, rather than median, because they do get blown out by some very large earners and some very large rental values at the same time.
So just for us non-data people, can you tell us the difference between average and median?
So mean is the average. That's the 50% mark, whereas median would take out the outliers of those really large ones. When we looked at that, Dubai was at the same levels as some of the biggest cities in the world, whether they be London, whether they be New York is in a world of its own, but Sydney and the other big cities. The difference, how it was judged on those, was the figures were done from disposable income. Now, in those countries, there's tax, right? So the tax was already taken out of theirs, and they were looking at almost just over 50% of their salaries going to rent. And that was the same in Dubai, but we don't pay tax.
Right. Okay.
So that really say that the affordability ceiling really got hit at the end of last quarter of 2025.
Okay, so going back then to job creation and employment trends, how critical are they to sustaining demand at current levels?
I mean, they're incredibly important, because when you look at the demographics of Dubai, we have the different segments of employment. You have the blue collar, you have the low, mid white collar, and mid white collar, and then you have the higher earners, and then you have the super high earners. The major percentage of the demographic is in the bottom two. levels. So any job creation in that element doesn't really move the needle very much when you look at sales, because they just can't get on the property ladder anyway. They're either in working accommodation or they're renting or co-living. So when we see those numbers start to drop off, then we kind of have to look and say, okay, if the job creation isn't happening right now.
There was an interesting comment on a good LinkedIn article talking about salary cuts and job loss. And it was a slightly cynical view that some people are letting people go to try to rehire those same jobs, but at a 60% rate of what it was previously. That is a little alarming because it sort of is perpetuating structural issues as it relates to job growth and job sustainability, but not placing it in the hands of the end user that we really need to. So there are concerns that we're seeing across different segments of companies with cash flow. It's not limited to real estate, although a lot of real estate developers, particularly like tier 3 or tier 4, struggle with working capital and are struggling with working capital right now. Other companies are as well. And so to the extent that, going back to another question, to the extent that there can be intervention from corporate indebtedness, and there have been some things done of extended debt forgiveness on a corporate level, things like that, that could help maintain a slightly healthier working capital overall, like cash flow for the larger economy, I think.
And what needs to happen? We touched on confidence, needing to restore confidence. What, in your opinions, needs to happen to restore that confidence?
I think we'd like to see people start hiring more. I think that there needs to be less cheerleading, more action, right? It's not just saying, oh, I'm not going to cut salaries. Well, that's sort of expected. The fact and the point of this article was that the conflict happened a few weeks in, and then companies were all of a sudden doing it. That meant that they were probably not the best well-managed companies to begin with, right? A 2-week hiccup, 3-week hiccup. So for our point of view, and one thing that I'm looking at and have been kind of banging the drum on for a while, is we're seeing these real estate values go, sky high. The job growth was flat though. So this is the point that Lynnette made, is like something has to give. Like if we're not moving in sync, then eventually something's going to have to come back down to get in sync. So that's what I would like to start seeing. It might take 6 months, it might take 9 months, it might take a year. I can't answer that, but I think that once clarity is in the market, then the risk has already been priced in to a certain extent. We've kind of been through the worst. Then hopefully we'll start seeing the right kind of reinvestment in people and infrastructure that will position us for the next growth curve. That's been Dubai's big story. When we had the global financial crisis, for example, and, I was here, I know that others were too. The fact that the metro didn't stop, the road networks didn't stop, the connectivity didn't stop, we didn't stop, but we reinvested. So if we get that kind of same sort of indicator, and we are with the new metro announcement, the new golden
line. Yeah.
new
Golden
line.
Nuggets line.
What a great product placement for you. I think that that's the boost of confidence and reassurance that is powerful. So that made me really happy when I saw that announcement. That's like, yeah, good. This is the leadership that we've grown accustomed to and we respect and acknowledge and applaud. Perfect timing. That kind of thing does speak volumes. It might not resonate in the next week or two, but it shows that long-term growth trajectory, confidence level. And it's not just good for Dubai, but it's good for the country and good for the region.
So I would say on that, I've been to a lot of talks, we're a startup. So startups are probably one of the first elements that get affected. A lot of business meetings, a lot of chamber meetings. And it seems to me that everyone is like, okay, we're struggling, we need help. I want to flip that on its head, because having lived here for 27 years, and I feel like I'm on a little bit of a political roadshow right now about this, but I've lived here for 27 years, and there's been so much incentives given by the government. The governments have an incredible open door policy for us to go and speak to the regulators. They've put so much into building Dubai to be what it is right now that it just reminds me of John F. Kennedy's inaugural speech. Don't ask what your country can do for you. What can you do for your country? And I think right now it's the perfect time for the private sector to support the public sector, not the other way around. Let's not ask the government what they can do for us. Let's ask what we can do for the government. How can we build companies or products or do something that gives confidence, that brings back those investors from international? That's what I think we really need to focus on.
I would agree with both. Obviously, two different perspectives. For me, certainty needs to come into the market. Once we're certain about the outcome of what's going to happen, then I see the recovery there overall from a macro perspective. What we're seeing, so at Real Trust, we deal with foreign investors, buyers, sellers who are investing or selling in the UAE. And surprisingly, a lot of foreign investors it's been very active since the conflict started. I thought it was not going to be. And quite a few from the US, which also trying to figure that one out. It's been...
Well, 50% of this situation room is American.
Yeah. So I was, so March was one of our best months. And in April, we've already superseded March. And again, these are all foreign investors. I would say more than 36 have come to us just to open escrow. So they haven't spoken to an agent. They haven't found a property. They just want to open up escrow, put the funds in there so that when they do find the right opportunity, they know their window is going to be very small. They're ready. These are very smart investors. And they're from the US and they're from Europe. These are the two predominant countries that we're seeing these clients come in from, which is surprising to me. I did not expect this in any way, shape, or form when the conflict started to see this kind of outcome from foreign investors. So they're there. They're waiting. They're also wanting to see certainty and wanting to see what's going to happen in the markets. The sellers are holding their price. The sellers are not wanting to come down in price. Probably of all the deals that we've transacted since March, 20% was probably the best discount that I saw from a seller. And also sellers are being very smart. They want to do due diligence on the buyers beforehand. This is something that was not very common before the conflict, but the sellers don't want to waste time. The serious ones who are looking to sell and exit, they want to do due diligence on the buyers before going into Form F, which is very smart, asking for financial source of wealth, source of funds. So it's been a very interesting 2 months from what I'm seeing from my own internal data. And that goes back to, I think, what Rakesh was saying in the very beginning. It really is your own proprietary data and the private data that you're looking at, which is in real time, versus a lot of the other stuff, which has lag. You have the market lag and it's not very comprehensive. So it's very interesting from that perspective, which gives me a lot of hope. Because in the very beginning, I was like, oh, the real estate market, and listening to my friends and colleagues who own brokerages and the scenarios with the leads and so forth, so on. I know the 3 guests that you had yesterday all touch upon that as well. But no, I'm seeing a very positive outlook from foreign investors, but they're smart. They're waiting. They're waiting for that right time. They have the time. And again, until there's certainty, for me, it's very hard to gauge how the market's going to go after that. But I do firmly believe that the recovery is going to take a while.
And I think uncertainty is the word of the year, because even though there is uncertainty, I love the fact that Lynnette said she had the best March and April's looking like a great one as well, because it's the exact same story for us. We had the best March. We're growing at 900%, onboarding new customers weekly. When there is uncertainty, what becomes value then is confidence and trust. And if the companies that provide that confidence and trust, they're the ones who are going to excel in the current market.
So
Yeah.
I wanna zoom out a little bit because I've got some other words of 2026, and the one that I'm hearing probably the most often each day is the Strait of Hormuz. So I'd like to know from a kind of micro perspective, how, okay, yeah, it's shipping, it's blocked. There's a blockade, there's a block on the block. How is this going to, and again, you know, we're just forecasting now, but what is going to be the impact on our personal lives, on our supplies, on maybe developers, on construction supplies, costs, everything? How is this strait ruining our lives?
I
It
mean, it's
won't be just ours; it'd be the world, really.
Oh yeah, sorry.
yeah,
So
it's
one stat that I saw that I did not know is that 65% of the world fertilizer comes from this region, and most of it from the UAE.
Yeah, I did not know that. So what's that? Fruit, vegetables,
Fertilizer for food,
fertilizer.
Mhm.
It's
For
a by
everything.
Everything.
for any kind of food.
But wait, if it's or
To the
sorry, if it's
cycles in Southeast Asia that don't have fertilizer, which then if that's 20% of the world's food that's not going to get planted, then that's going to lead to rising food prices.
okay, so if the fertilizer's already in the UAE,
It's created in the UAE.
it's
it's a
created in the UAE, but it's not. We're not growing fruit and vegetable in the UAE,
no.
right? So that needs to go down to South Africa or wherever, and then
Yes.
it comes back through the Strait of Hormuz. So
On a ship that travels at about 15 knots, which is about the same speed as me on a bicycle after a big lunch.
right.
Yeah.
So I'm again going back to my alarmist state. Should we be, is this an argument for stockpiling, stocking up on water, stocking up on rice, oats, canned goods, tin goods?
I think being in the UAE, you're probably in one of the best countries in the world to withstand it. They showed how well they handled the supply logistics breakdown during COVID. You saw the stockpiling in many other countries in the TV. We didn't need to do that here in Dubai. We didn't need to do it at the start of the current situation. I call it the situationship. But I don't think people are pricing in the real risk of what's going to happen long term. We are predicting a period of global stagflation with much higher inflation and job losses happening at the same time. I don't.
Is that what stagflation is?
Stagflation is higher inflation, more loss of jobs, more
Yeah.
unemployment.
Yeah.
Price increases just since the start of this. So the reason why the boats aren't going through the Strait of Hormuz didn't start with a military aspect. It started with insurance companies and the premiums that the shipping companies had to pay. They went up 400%. The freight rates, the cost of sending something by ship has gone up 250%. Helium has gone up 115%. Methanol, 78%. Ammonia, urea, which is the fertilizer, and nitrogen, 49%. Jet fuel right now is skyrocketing, meaning less tourism. There's all these different aspects that have actually come from the Strait of Hormuz, from the GCC region, that people didn't realize was so valuable to the world economy. And now they're realizing just how important it is.
Yeah,
These
because and they're saying
fixes either. Oil rigs that have shut down take months to restart as they repressurize. The gas that has been taken offline in Qatar, which basically creates a lot of these other elements, whether it be helium for creating silicon chips, or the helium, urea, nitrogen, which we need for food production. It's just all intertwined, and that's globalization at a specific level, and that's the effect that we're going to see coming probably in the next 12 months.
so. No need for stockpiling in the UAE, but probably in the UK, right?
Look, the situation is still rather tenuous, right? We're not getting a clear picture. It is a standoff, and the downstream impact globally, whether it's jet fuel, whether it's fertilizer, whether it's actual other real oil products, is something that people are really starting to get a little bit nervous about. And rightly so, because even if everything stopped and things could go back freely, we have this 7-week lag that you can't recapture. You can't make up for that lost time. And then you have other impacts. So a lot of economists are really worried about overall global GDP growth, and they've revised that downward in the sense that this impact is really significant. And if it doesn't get resolved quickly, then it could become even more where we're at like a global zero growth, which is not good. So we are very lucky in the UAE because we are buffered by some of these almost existential threats. Virtue of our location, whereas others are not. So in many ways, we're protected. I think that's probably one reason why so many inbound inquiries were coming Lynnette's way, because they're recognizing that we are a safe haven that's somewhat insulated from some of this. But if there is a larger global shock, it will still impact everything here as well.
Yeah, it really is a domino effect. And everything is intertwined, like Rakesh said. And we really won't see the effects for another couple months, like truly start to see the effects for another couple months, like mid to end summer.
So
Yeah.
it's 23rd of April today, and a lot of people are still talking about Q1 results, and we've had record Q1, which takes in a fantastic January, kind of cancels out the March result. But when are we going to know what the real impact is? How many weeks do we have to wait to get the real March and April data, and what numbers should we be looking at?
So from the real estate market, let's just talk residential. What we're seeing recorded for off plan is what was actually signed in December, January. So we won't see the true effect of off plan until probably, I would say, June, end of May,
Oh, wow.
June. Then when June starts, we'll start to see the true effect of this conflict for the off plan market. For secondary, there wasn't a lot of mortgages, actually. I was looking at that. It was less than 20%. So mortgages take 3 to 4 months. So there's that lag of 3 to 4 months. And a lot of mortgages didn't actually come to fruition. So what you're seeing is pure cash deals, and they take a few weeks max. So that's why I'm very focused on the secondary market, because for me, that is truly what is transacting today, the real numbers. So that you can look at today. And so, for example, in April, I believe we had 5,000 secondary sales transactions thus far. And we had quite a few in the ultra luxury market, which is
That's
good.
a good way that's a new name for it. Luxury. Without the L, drop the L.
Ultra luxury.
Okay. Let's talk about tourism, because it's something that we try, in real estate, we rarely talk about it. We just know, it's a very important part of GDP, but what can we expect? What are we seeing in terms of hotel occupancy? A lot of news about hotel closures for refurbishment. I mean, it makes sense if things are going to be quiet for the next couple of months. It makes sense to refurbish now, but what are your thoughts on that?
It was hit hard, and we need to be honest about that. If we are seeing occupancy levels at 23%, which is what was reported, that's obviously not sustainable. Combined with the fact that we're coming into the summer, it made sense for some of these hotels to actually shut down and take a pause. The problem with that is that becomes a reallocation of labor. Not all those people are still here. Some may have been reallocated to other hotel properties globally. We are going to start seeing a pickup in tourism. We already have, predominantly coming from Russia at the moment, but that's only going to move the needle a little bit, right? With the relationship from tourism to retail, which is a focus of a big portion of my business, the retailers have been struggling. The F&B has been struggling. So
But everyone's out. We see everyone out in the malls, in the restaurants. What's going on?
So there is something that is both reassuring but also alarming, right? The reassurance is that people are out. The reassurance is people are spending, but they're spending on things that are more urgent level necessities. So, it's the revenge of the working middle class, if you will, where now the malls have been repossessed by them to a certain extent because the luxury high freewheeling, tourists are not there. You can actually see it in the demographic of the people that are at the malls. There have been some significant shifts at a couple of places. So then you also have this emergence of UAE loyalty, which has been reduced rates for staycations, reduced rates for residents. There was nice promotions going on by Entertainer and Faza earlier in the conflict. And that's a really positive step. When you talk to a lot of long-term residents, we've been seeing the cost of living increase greater than probably our paychecks were. And so we're also sort of breathing a little bit of a sigh of relief. Okay, this town is becoming a little bit more affordable for us again. But it's a double-edged sword, right? 25%, 30%, even 50% occupancy levels across the board is a problem. We've also lost a significant amount of MICE activity, so meetings, incentives, conventions, and yeah,
I thought you actually meant
MICE.
mice. Like, that's a good
Yeah,
thing.
but not in my house.
There's less mice.
Not in my house. And so, we've lost some of those big events. Okay, some of them have been pushed back, but those are nice, good, stable economic engine kind of things. And, pushing that now down to the fall is a hit. So look, the tourism, F&B, and retail groups are in the middle of looking to figure out how they're going to sustain this, how they're going to manage it, how they're going to continue to deliver a product that has a certain high demand, even in periods of uncertainty. And the best ones are looking at ways to show and demonstrate that resilience as opposed to just saying, okay, I don't know what I'm going to do. I'm going to keep doing what I was doing and expect that the situation will change. So it's a critical element to this market. It will come back.
Yeah, Lewis said as soon as Emirates announces £100 flights from the UK, don't worry, everyone will quickly forget that this ever happened.
They may forget
Okay.
that it happened. I have a little bit of a more cynical view on it. And it comes back to affordability. A lot of these restaurants that are now struggling, hotels, outpriced the resident. The resident wasn't able to go to a lot of these restaurants, wasn't able to go to a lot of these hotels because we just couldn't afford it. Now, the people who could afford it were the tourists and the really high-end residents, the people who had the ability and the means to leave when they started, unlike the lower mid-class. Now, these same restaurants are saying, well, we're going to offer discounts now because we've got no of our usual customers. We need these other people to come in and save us. So it's almost like they've said, well, we priced you out at one level. Now we need you to come and save us. So we're going to give you these great discounts. And I'm going to take advantage of it. I'm going to take advantage to go to a 3 Michelin star restaurant, pay 350 dirham for a
Caesar salad. Caesar salad. Rakesh has this great story about a Caesar salad, and I'm so glad you brought it in. That was on my bingo card.
Yeah, so it was outpriced, and now they're coming back and they're making it seem like it's a community service announcement that we're doing something good, but in fact, you need help from the people you priced out, and you shouldn't forget that, right? The lower to mid-tier community of Dubai is the part of the community that build Dubai, right? They're the people in the service industry. They're the people in the construction industry. They're the people in the medical, in the hospitals, in the police force, the ambulances. That's all that market. And when you say, what I noticed is those higher end places are the ones that are suffering. The mall is incredibly busy because it's a free event. People can afford to go to the mall. The beaches are absolutely packed because it's a free event and people can afford to do that. They don't have to fight the traffic. When they announced Miracle Gardens was free, absolutely packed, right?
Yeah.
It's these types of things that the residents of Dubai can afford and will do and will spend money at rather than these high-end facilities. Now, will that come back? Yes, it will, but I don't think it will for a long time. And I don't think the lesson should be forgotten about who came to your rescue in the time of need right now. And it was the lower to mid-tier residents.
Well, to bring that back to real estate, because that's probably what's happening on the ground now when it comes to the landlords and sellers of February are now in that position where they're going to have to be a little bit nicer to the buyers and the tenants. So this is a great opportunity to get your advice. If someone is listening to this and they're either a seller, a buyer, a landlord, or a tenant, what would you be telling them right now?
I can only speak for the landlords. I can't speak for the sellers. From a landlord, it is to be flexible. We released a risk memo in the early days of the situationship where we stated exactly what landlords should be doing. Number one, they should be looking at what type of tenant it is and where that tenant is employed, because there are certain industries that were facing serious job loss. So that was a risk that they had to look at. They should also be offering more incentives, whether it be great property management, whether it be a digital solution, whether it be the flexibility of monthly payments, whether it be taking Takeem as your rent protection to protect both landlord and tenant. It's all those types of things now that are coming into the market. We know that they're still going to get a decent yield, but now the one element of this, and probably the shining light of this, is that renting is going to become more affordable. Unfortunately, other things may increase, but renting, which is our biggest expense of every person, is going to become more affordable.
So you have got advice to tenants then. Wait until, when do you think it's going to hit bottom?
Tenants can completely negotiate. Everyone used to ask us when we spoke about the volumes declining, so when a price is going to drop? That was always the question. And it would usually be a 6 to 9 month lag in a normal market. This has accelerated and magnified it. So the price drops are going to be happening. They're happening today. We're seeing it in the market today. I'd say the average is around a 15% drop on renegotiation. How much further it goes, I would say max probably 25%, and probably that within the summer period when it's usually that quiet lull anyway.
Okay. Any advance on 25%? 30, 35, 40? No?
I don't think we want to see it at that level. I mean, you can, on the one hand, think, great, there's now incredible affordability. But if we do start seeing a decrease, then that means the situation is probably a lot more complicated than we'd like it to be. I mean, if we're looking for buzzwords or phrases, I think that in general, the anticipation is for a soft recovery. It is something that is not, as Lynnette mentioned, V-shaped or dramatic. If we're able to kind of keep that going, then that will build the foundation for another prolonged growth period. So that's I think one way of looking at it.
Any advice that you want to direct towards buyers, sellers, landlords, tenants, or even agents, brokers, the brokerage community?
Look, I'm probably not the best person to talk about the brokerage community, but I think that all of us are real estate end users, right? We're all space users, and so are making interesting adjustments ourselves, whether we realize it or not. I'm probably a little bit more acutely aware of looking for the deals that Rakesh is talking about, or giving advice to global buyers of now is actually an interesting time to dip in. I mean, I think that this inbound volume, again, that Lynnette was talking about, is people that missed up on the significant appreciation and increase potential that happened over the course of the last few years, are seeing it as an interesting buying opportunity. I think tenants have a lot more flexibility than they've had since maybe 2020 or 2021 to request more mutually beneficial terms. I mean, it's not always so one-sided, but the pendulum does swing ultimately into, hopefully it will settle with a little bit more of a mutually beneficial market, not just landlord wins all and the tenant is sort of, out of luck. So I think that dynamic is shifting.
So for sellers, the first thing I would say is really assess the value of your property. Do you think your 2-bedroom in Blue Waters is really worth $12 million? Probably not. So come to reality of what the true value of your property is, especially if you're a motivated seller. And then the other thing is to do due diligence on the buyer before going into Form F. Make sure that this person's not going to waste your time. Make sure that they have the funds and that it will be a quick close. For the buyers, especially foreign investors, open up escrow. These guys, like the 3 dozen or so that we've seen over the last month, they're doing it the right way. Put the funds in escrow, be ready so that when you have to come up with that 10% security deposit check, you put it down and you lock the property. The opportunity will be there. Once certainty comes into place, there will be that bottom like we saw during COVID. And also, Silvia, you've known me for a very long time. During COVID, I pretty much emptied all of my savings into property. I bought like a crazy woman. And it was one of the best things that I did. So that opportunity will come back. It will come back.
Okay. And I want to wrap up now, unless anyone's got any closing comments. I know Stewart has a plane to catch, so we're conscious of time. He's off to the Seychelles tonight.
Yeah.
Yeah.
Tough life.
Nice.
Getting quick before that jet fuel cost goes up and flights get super expensive. But yeah, just want to check before you go, Stewart, is there going to be a real estate analysis coming out this week? And if there was, what's it going to say? Give us a sneak peek, a preview.
That's a good question. There's always a real estate analysis, whether I'm here away or anywhere else. It's become part of my weekly routine. Look, the notion that the market is in shift is getting the attention of more prominent voices and not attention of people that are by default wanting to go for noise or like dramatic soap opera like headlines, right? So Bloomberg today came out with a very balanced, well quoted piece saying, look, we're in a correction. They've acknowledged things that we talked about: population shifts, job shifts, impact on tourism. So it's important that we realize that we can talk about these things and it doesn't mean that it's a binary Dubai is up or Dubai is down. Kind of losing the bigger picture. This is a resilient place. We are going through an really unusual situation that I think that the leadership has handled well, that those of us that have been here have been able to cope with rather well, and we'll ultimately be stronger for it. So we are facing some interesting new tensions, but it does give an opportunity for the better performers, the better companies, the better organizations, the better business plans, the better strategies to come to fruition. I look back at the interesting organic change that happened here in 2009 and 2010. And one of the things that I was noticing was the absence of a creative class. Like, you really had to look for art, for example, back in those days. There are a handful of galleries, but there wasn't like little places. There wasn't a design district. There wasn't Al Circal. There wasn't this, creator kind of community. And it took a little bit of attention to help that kind of gain its footing and grow organically. So what is exciting to me is that we're in a correction. Hopefully it becomes a soft recovery, but that something even greater is going to come from it. And I think that we're seeing that again, hyping up the metro investment announcement. And I think that also the idea that Rakesh had brought forward of what are we going to bring forward? Where are we going to contribute? I think that we're going to be in the middle of that sort of rebirth, if you will. It's not that we went away, but we're going to be different than we were a year ago. Okay, cool. So there's been a lot of news. There's a lot of talk about when is this going to end and where are we going from there, and that kind of thing. So I'll probably focus on that a little bit. I'll definitely refer to the Bloomberg article. There was a really good article that was featuring Rakesh and his company. The headline might not have necessarily matched the content, but it was also good to see the openness and visibility of new ways of trying to structure a lease transaction. It doesn't necessarily have to be just 12 checks. There is a reason why that we want to avoid that, because we're trying to avoid default. We're trying to avoid those situations. So I think that that's going to be part of the compelling narrative of this week. Every week is different. That's the part of the fun of being here. We get a lot of interesting things coming on. It's trying to filter through what is hype and what is puffery versus what is interesting and real. And that's what those that are wanting to value that information will use to their advantage.
And I really appreciate all of you taking time out of your day and just before your flight, Stewart, to come and join me.
It's no problem. We're good.
No problem. We did well on time, but you guys are always welcome back in the Situation Zoom. I'm sure there's going to be more data that comes out, something more relevant as the weeks go by. So the door is open. Please feel free. When there's something new, hot topic, please do reach out, come back. And everybody listening, watching, thank you for joining us in the Situation Zoom, and be sure to follow Lynnette, Stewart, and Rakesh for more daily golden nuggets. Thank you very much.
Thank you.
Thanks for having us.
See ya.